How the wealthy keeps buying real estate without running out of cash. Have you ever wondered why some investors consistently, year in, month in, month out, they keep buying properties, and why there are some that even struggle to buy one? Have you ever asked yourself that question? What will be your answer? I have a lot of clients building their portfolio that way, and upon me asking questions and looking at the trend, how they do this, I got to realize, ask yourself this question: why is it that some people constantly invest in real estate, different aspects of real estate in their portfolio? Why there is one person out there that they even struggle to invest in one? Have you ever asked yourself that question? And the simple answer is this: for those ones who keep buying year in, year out, why they keep buying or how they keep on buying is because they've understood the trend whereby they've created a system or a strategy whereby their money tends to work for them, or their money tends to build wealth for them. If this is something that interests you today, I'll say pay attention, because what I'll be saying in this video today is not things I read online or things I heard somebody do. Is the things in which the clients in my client base are actually doing on a daily basis. Stay tuned. Let's dive into the video now. Note, before I continue this video today, I want to appeal to realize that this video is not a video for you to get rich quick scheme. Okay, it's very important I say that, because some people might think it's a scheme. No, I'll be breaking it down to us one after the other. Now, one thing you should pay attention to is, if you understand the strategy, then you are doing yourself a lot of good today. Now, what many average investors tend to do is that when they get one property out there, they take the entire liquid cash they have and they invest in a particular property. But what the smart investor or what the wealthy tend to do is that when they see an asset, they tend to invest in the asset, but they do not pour their own liquid cash in that asset. The reason is because if they pour all the entire liquid in that asset in terms of liquid cash, then if a new opportunity comes out, they will not be able to do anything. And upon that, that is what separates an average investor from a smart investor. So now I'm diving into the strategy one after the other, and you will need to pay attention at this point, because this is at the sensitive time in which I'll be breaking down to us. Number one strategy in which the smart investor tends to use is going into a payment plan. Going into a payment plan. So let's think of this. There's a property, there's a 3-bedroom bungalow selling for 78 million naira. And let's assume that they've said if you buy outright, you're going to pay 78 million. But if you are also going to spread the payments over the next 7 to 8 months, you're going to buy it for 5 million naira extra. The average investor might say, no, I'm not going to pour down the entire money. Or the average investor might say, I'm going to pour everything down, let me just pay everything cash and I have the property. But the smart investor is going to be like, no, I'm not going to pour everything down. Let me just pay the initial deposit and pay more month after month. Because at the end of the day, either I pay outright or I pay installments, the property will still appreciate in price. So it's going to cover up for anything I'll pay extra. So I'm quite fine. So why they do that is because they want to have liquid cash for them to invest in something else. So strategy number one is, if you want to be that smart investor, always follow the payment plan. Don't pour all your entire liquid cash out there, such that you will be limited by the opportunities you could sort of bring onto your portfolio when it eventually appears. So strategy number two, which most people also make use of, but I want to reiterate on it, is buy income producing assets. This might sound weird to us. I'm not saying buy a house to just do short let, no. But when I mean income producing asset, I'm talking about commercial properties now. So I don't want to use residential, but I want to use commercial property because it's becoming to be a big thing in the real estate market as of today. So think of it today, you've bought yourself 5 shops. And how did you get the shops? It was simple. What you're doing was, as soon as you keyed into it, you're paying installment. The 5 of them are now yours. Upon even them delivering the 5 shops, you already even have people that wants to rent it, not just short-term rental, but long-term rental, let's say 5 years. And let's assume that you've bought these places in a strategic location. So what happens at the end of the day is, you have an asset that's producing you income, and what those income tend to do is offset expenses. So how does it work for a smart investor? A smart investor buys the shop, buying the shop produces income, the income is used to offset debt, used to offset expenses. So he wants to buy fuel at home, he could use that. He wants to pay school fees, he uses that. So you need to also produce, or you need to have in your portfolio assets that produce income, because you don't want everything you want to do, it has to be from your real income. So let's assume you're working for an oil company, or let's assume you're working in the tech space. If you want to do anything, keep on taking it from your real income. But think of it this way: they've bought themselves an income producing asset, whereby if they are taking the expenses from there and properties appreciating in value, they could actually literally be saving their income, or they could be using their income to even chase another assets they want to buy. So you can use the tweak there. So it's important in your portfolio, if you want to be that smart investor, you have income producing assets as part of your portfolio. So number 3 strategy I want to also imbibe, or that I want to tell you as an average investor, so if you want to be that wealthy investor or that smart investor, is that you need to learn that when you're buying real estate, it's not about you buying real estate as a one-off investment. You're actually building a portfolio for yourself. And when I mean portfolio, it means in your portfolio of wealth or a portfolio of real estate, you have different types of real estate. You have the commercial real estate, you have residential real estate in that. And if I want further break it down, you might even have it from the point of locality as well. You might have one house in Lagos, one house in Lekki, one house at Ikoyi, one house at Abuja, then shops, one shop at Ibadan, 3 shops at Kano. Can you see how they break down? Some people want to even break down. Some people, I'm aware of some people even owning car park spaces. 1 car park space in Lagos, 2 at Nasarawa. You see, like those are portfolios. So what that means is that if you understand what it means to build a portfolio, then what you'll be asking anybody that brings real estate opportunities to you would not be which real estate should I buy. You should be looking at if that real estate suits your portfolio. And if it suits your portfolio, that is the starting point for you to make inquiries. If it doesn't suit your portfolio, you just pull back and be like, I'm not interested. It does not suit my portfolio. So it's very, very important that real estate is not just a buy one-off. It's actually you building a portfolio for you to be that smart investor as well. In conclusion, one of the biggest lessons I've learned from working with a lot of millionaires and billionaires over the last couple of years who have built it through real estate, I've been able to jot something down as a big lesson I've learned from them. The wealthy focus on leverage, because they see real estate as a step or as that thing that can take them from point A to point B. And let me give you a good example of leverage. I know of somebody that when was much younger, he was just buying properties in strategic location. He retired, I think, around 60, and all he's just doing right now is, if you say you're interested in JV, he's going to give you his land, and he's going to tell you this is the unit of house I'm going to take. So he sees real estate as that leverage system for him to expand his wealth. But while expanding his wealth is also that leverage that can make him somebody to own houses. Okay, so it's a leverage. Another example is you want to send your child to university. You can decide to tell yourself, oh, let me buy this land at this age. In the next 10-15 years, I'll sell the land, and the total amount of the land will be focused on the university education of my child. So you can see that's the definition of leverage. And second of all, the wealthy focus on cash flow. So if real estate is not giving them cash flow, they don't see it as, in as much as they see it as real estate, they also pay attention to it that if it's not giving us cash flow right now, will it give us cash flow in future? So it's very, they pay attention to that as well. And last but not least, they pay attention to long-term appreciation as well. Okay, they make money work harder instead of simply working hard for money. Okay, they make that money work harder, so they don't just invest out of emotions. They invest paying attention to the necessary details so that they don't end up wasting money, and the money can really work hard for them to actually make more money. And this is something I've observed about the wealthy a lot. So in conclusion today, I will say, don't be a buyer of real estate, but be somebody who is an investor. And don't think of you buying just real estate, think of building a portfolio. If this video interests you today, please kindly like, share and comment on this video so that more people can see this video and they can learn of this opportunity as well. Once again, my name is Temita. Bye for now.